Will this be my last Vanguard portfolio update? Well, judging by the wider YouTube space, it might just be, as Vanguard users have been leaving in droves for the new financial year to a brand new platform which, until a few weeks ago, you'd likely never heard of until now.
Invest Engine.
Invest Engine.
Invest Engine.
Invest Engine.
Invest Engine.
So I want to give my thoughts on Invest Engine. Is it better than Vanguard? Should you be considering moving to them? And ultimately, is it my time to finally move my portfolio away from Vanguard, which I've been with for 4 years? On top of this, I want to spend a little time highlighting the biggest dangers to all our investing portfolios in 2022. And realistically, what should we be doing about it? And then explain why I've invested so heavily in the last months. 3 times higher than normal, in fact. All of this before I transparently share the performance of my real-life Vanguard portfolio and show you all the gains and losses I've made in just the last month. So it's that time of year where we get trashy creators saying they're finally quitting YouTube on April Fool's Day. That also means we get a brand new wave of the best stocks and shares ISA videos. We've had videos from Damien Talks Money, Chris Palmer, Sasha Yansin, and even my best mate over at Money Unshackled.
Distasteful.
And they all had one thing in common.
Invest Engine is cheaper, that is a fact, and Invest Engine have more funds to choose from. Again, that is a fact.
The cheapest way currently to do this is going to be Invest Engine. If you want to invest in just the stock market index, like the S&P 500 or whatever, my personal number one pick is Invest Engine.
Transferred my main ISA from my old investment platform, Trading 212, to Invest Engine.
Invest Engine being their preferred choice. But let's take a step back. Who are Invest Engine and where did they come from? Well, they are the new kids on the block, and they're aggressively making a big push in 2022 to corner the ETF market in Europe. I say this as they very much said this in one of their adverts.
Only 15% of retail investors in Europe currently invest in ETFs, compared to 40% in the US.
So from their point of view, they see a gap in the market of 25%, which is unfulfilled demand, and they want to fill it. And Invest Engine was founded by this chap, Simon Crockall, who was one of the original founders of Gumtree, which later sold to eBay. But Invest Engine have a massive problem. Nobody knows about them, which isn't good for business. The basic economics of any investment business, and in fairness, most businesses, is that they need to harness economies of scale to be successful. Basically, you want as many customers as possible to spread your fixed costs across them, meaning you can lower prices and be more competitive. Going off data on their website, they claim to have 6,000 active customers with total assets of over £30 million. But let's be clear, that is a small amount in this space. That's roughly 0.005% of what Vanguard have globally. So in order to get to the size they need to do to ultimately survive, they need to offer a better product to incentivize customers to move to them, all while having a smaller customer base to spread their costs over. Is very much go big or go home. Based on this, it is no surprise that when you look at their accounts online, you can see that they're burning through cash at a very quick rate. From statements that we can all see on Companies House, we can see they made a loss of over £1 million in 2020 and £2 million in 2021. And with that said, the trend is likely to continue for this year, as they are now throwing lots of money at content creators on YouTube in the form of affiliate links to get the message out there. And in fairness to them, it's working. I'm sat here talking about them right now. I've got my patrons asking about them, and you can basically see it all over YouTube. But don't be fooled in thinking that it's only being pushed by creators as part of a shill, as that really wouldn't be fair. Invest Engine are offering lower fees than Vanguard, with lots of ETFs, including Vanguard funds, all while offering additional incentives for people to join them. So from a purely numbers point of view, moving to Invest Engine is a complete no-brainer. Equally, I think it's unrealistic to think that YouTubers aren't going to be influenced by affiliate links. I would, within reason. But if a creator pushes a ropey product while pocketing cash, I wouldn't take to it too well. But in this case, I actually believe that all the creators that I might have referenced in this video are actually providing a valid testimonial for their viewers. I'm sure that these affiliate links do push them more front of stage than they would be if they didn't have an affiliate link, but I do believe they would be talked about widely, as they do have insanely low fees on offer. Take me, for example, as I have over £50,000 in Vanguard. If I transferred to Invest Engine before the ICE deadline, I would have landed an additional £225, which would be 0.5% uplift on my portfolio even before considering the lower fees that I would get from that platform. It's not a bad deal. So the question is, am I going to be moving my stocks and shares ISA from Vanguard to Invest Engine for the new tax year? No, I'm not. If I'm honest, the £300 annual benefit that I would get for doing this just isn't really worth it in my eyes. The main reason being that I'm actually not entirely confident that Invest Engine will be around in 5 years' time. As of a few weeks ago, they only had 6,000 customers total, but I'll admit that this number could have doubled or maybe even tripled since their latest campaign, but this still wouldn't be a good economies of scale. Based on this, they're likely going to be burning through cash for years to establish themselves, especially against all the gigantic players in this market. This does concern me a little bit, but it isn't what tips me over the edge. What really concerns me is the fact that they're already resorting to crowdfunding to raise capital. And let's face it, we've only just heard of them. If you go to the website, you'll see a large banner across the top that says, "Our crowdfund is live." When you take a look, you can see they've actually raised over £1.2 million, giving their company a valuation of just short of £16 million after selling just 7.21% of the company. For me, that investment would be nothing but extremely risky, as investors are buying into a company which is increasingly losing money. And I would go further to say that it's actually fairly likely that this will not be the last time that they'll need to raise money through crowdfunding or something similar. This meaning that any shares purchased in this investing round will likely be diluted by later rounds when they're raising more funds. For me, the information available to potential investors in Invest Engine is fairly lacking. No projections on their expected growth over the next few years, and no clear plans on what their fee structure will look like in the future. And I say this thinking that it's going to be extremely unlikely that they're going to be able to hold their current fee structure in the long term, especially if they want to be profitable. As it stands, nothing about them looks that sustainable in my eyes, but props to them for giving it a go, and hopefully it'll work out. And on the other hand, when we look at Vanguard, I am beyond confident that they're going to be here in 5, 10, or even 50 years' time, and will very likely outlive myself. Vanguard's ownership model is built completely differently to all the platforms, which I discuss in this video here, which gives them a long-term competitive advantage. If you haven't seen this video, then I'll make sure I put a link to it at the end of this video. But saying all this, I am not beholden to Vanguard. I'm not affiliated with them, even though I wish I was. I might choose to move in the future, but at least for this year, I am staying put. So as a summary on Invest Engine, I understand why people would move to them to take the short-term benefit. I'm doubtful of their long-term success, and I certainly would not be investing into them at the moment, especially based on the limited information that they've been able to give. But I would love to know your thoughts on them, if you've moved to them or if you haven't. But before I jump into my Vanguard portfolio update, I just wanted to quickly highlight what I think is by far the biggest risk to our investment progress in the coming year. No one will be able to escape this, and it's the cost of living crisis. We all know that inflation is now here, but the one element that I don't think is appreciated that much is the fact that it's going to be getting worse over the next 12 to 18 months. I actually work in an industry where I get sight on commodity pricing, and prices have already increased for consumers, but they are going to increase a lot more over the next 12 months. But why would this matter to us? Well, I'm sure that as an investor, we've all played around with a compound interest calculator. We whack a reasonable number in there and give a little projection of what we think we might have in the future. But what we won't have factored into this number is the fact that our incomes might be going backwards due to a cost of living crisis. The latest estimates show that the average annual household energy bill will increase by £2,600. So for a couple, that's over £100 out of pocket per person per month versus the year prior. And this money will be coming out of our disposable income, meaning we just can't invest as much as we did before unless we're going to reduce our living costs, which, let's face it, no one wants to do. And then on top of this, fuel is going through the roof and the cost of everything else is quickly rising. So unless you're starting to earn more money this year, then you're going to be taking a steep step backwards with your investing plans. Personally, my advice would be, if you've not had a pay rise of over, say, 5% in the last 12 to 18 months, then you need to get out there and earn a bigger salary. As discussed in this video a few months ago, the labour markets are extremely tight in the UK, and I personally know several people who have moved jobs in just the last 3 months who have earned 20, 30, or even 50% more in their salaries. There are mountains of businesses out there who are desperate for the right candidates to join them, and they are throwing money at the problem. In terms of what increase you should be really looking at as a minimum to combat this rising cost of living, you're probably going to need an extra £200 per month, which, depending on your tax banding, you'll need to earn either £2,400 or maybe up to £4,000 more per year just to stand still. And I can say with a high level of conviction that it's likely that anybody watching this video could get a pay rise that's that big if you're willing to look for it. And it's actually likely you could get a lot more than that. Luckily for me, I've actually just stopped paying off my student loan, which means I now have more money flowing into me without increasing my salary. If you have moved jobs recently, I'd be fascinated to know what percentage increase you've been able to get if you could let me know in the comments below. Right, let's get into the good stuff. How has my Vanguard portfolio been faring over the last month? Well, if this is your first Vanguard portfolio update, then there's only two things that you need to know. The first is that I only invest into VWRL, which is a FTSE All-World UCITS ETF, which is basically just a broad global ETF. And then second, I've been investing since the start of 2018, so I've just entered my 5th year of investing. This month, I've actually ploughed a lot more money into my Vanguard account than I normally would do. But no, it's not because it's the end of the tax year, or I believe that prices are particularly low at the moment. Normally, my direct debit is £940, but this month I've decided to add an extra £2,500, meaning I've nearly invested £3,500 in total. And it's all down to two things. One, I've got a bonus from work, and two, I am a massive believer in lump sum investing. All the data shows that lump sum investing, on balance of probabilities, is the best investing strategy. Better than dollar cost averaging and better than trying to time the market. I get asked consistently about what people should do if they've got a large amount of cash on the side to invest. Should they put it into the market all at once, or should they drip it into the market with a dollar cost averaging style? Well, the choice falls down to only a handful of questions. The first is, what is your risk tolerance? Does knowing that lump sum investing fails to beat dollar cost averaging just 1/3 of the time bother you? Or are you more bothered that there might be a potential massive drop just after you lump sum into the market? If you can accept the stats on it that you're open to the outcome, that there's only a 1 in 3 chance that you're going to lose out to dollar cost averaging with lump sum investing, then that's what you're going to do. You're going to back the numbers and lump sum invest. So what has this additional £3,500 done to my portfolio? Well, it's contributed to a notable jump of nearly £6,000 versus last month, which is nearly a 10% rise. Last month, VWRL was trading down following the invasion of the Ukraine, and at the start of the month, it was down to £86, but actually did fall another 4% lower to just £82 on the 8th of March. Since this point, though, the stock market seems to have completely changed its mind and rallied by nearly 9% in just the 3 weeks following. This boost in performance has moved my portfolio value from just short of £70,000 all the way to £75,995, which is the highest it's ever been. If we look at the graph view of my portfolio, then you can see that overall my portfolios continue to grow steadily with my constant direct debits, only with a few spikes along the way. If we look more closely at 2022, you can see that actually we've been continuing to decline throughout the year so far, only with it picking up just in the last month. In terms of how much profit I've made from this portfolio so far, as of right now, I've got a return of £16,765, which gives me a time-weighted return of just short of 57%. For context, this calculation is based on how long the money has been into the account, rather than just a factual increase of my £17,000 profit versus the total portfolio value of £76,000. If the percentage calculation wasn't based on how long my money had been in my portfolio, it would mean that every time I invested into the account, it would lower my return, which would be a false number. To show you what the share price has actually done over the last 4 years, you can see that on this graph, the price of VWRL over this period has fluctuated up and down, but over the long term, it has continued to increase. You can see there's been a few large dips, the first being the sell-off in autumn 2019. We then had the COVID crash, and more recently, we had the early 2022 sell-off. But overall, the market has continued to go up. Over this period, you can see that I've consistently been investing, no matter the price, no matter the situation, which is highlighted in green. You will notice there are 2 red dots which indicate sales on this account, but this has only been where there hasn't been enough cash in my account to settle my quarterly bill. So it means that I'm automatically forced to sell a share to cover this. As it stands, my average buy price is £71.96, meaning that on average, I've made roughly £17 per share, and I currently hold 853 shares in total. But do remember, this doesn't include dividends. And talking about dividends, I've just had my Q4 dividend payment announced, which is just short of 25p per share, meaning that over the next 2 weeks, I'll be receiving £200 for just simply holding the shares, and I've had to do nothing for it. So it's truly passive income. I'm not going to lie, I would love to hit 6 figures in my Vanguard account this year, but I don't think it's actually very likely unless the stock markets rally a hell of a lot. As said before, there has actually never been a better time to take advantage of the tight labour markets that we're seeing both in the UK and the US at the moment. If you want to take advantage of this opportunity, then I would highly recommend you check out this video on my left-hand side. But if you wanted to know more about Vanguard's unique ownership structure, which I believe gives them a long-term competitive advantage, I would check out this video on my right-hand side. That's all for this video. See you in the next one.